Hey everybody, big night tonight. FOMC rate decision. Uh, the Jerome Powell's press conference is still actually going on while I'm filming this little film here. But judging from the market reaction, this is not a big deal. Overall, the markets are interpreting the Fed decision more or less as expected, or maybe slightly to the hawkish side. Equity prices were selling off. We have seen reaction in gold prices drop, the dollar strengthening, all the signs of more hawkish than expected. The rate announcement, but not dramatic in any way. Obviously, we got the rate hike we expected. Everybody expected that. The market expected. The Fed is now signaling that we'll have 2 more rate hikes this year. For those of you who have read our Global Monetary Conditions Monitor, which we published yesterday, on Monday rather, we had expected this. Everybody else, I think, had expected this more or less. The market pricing will have a September hike and a December hike, so no big deal there. So I don't want to go too much into the details because most of it was as expected. The dot plots, the projections of the FOMC in terms of future rate hikes is moved off slightly relative to March, but again, no surprise there. But I would say if the Fed followed through on that, then the Fed will cause the US economy to go into recession in 2020 or 2021. And the markets still don't believe it, even though the Fed today essentially repeated what it said in March in terms of continuing rate hikes through 2019, 2020. But I've moved the profile up a bit. What I think is interesting is our own indicators, what they are saying, and what really comes out is that we've just been doing the number crunching here as the statement from the FOMC came out. At every statement the Fed does, and also for a number of other central banks, we do what we call a forward guidance indicator. We simply take each policy statement and look for hawkish words and dovish words. We have an algorithm that does this automatically, and it's essentially the ratio between hawkish and dovish words decides the level for our forward guidance indicator. And what really is striking here is that there was a quite significant jump in our forward guidance indicator. We had expected a slight jump in the forward guidance indicator, but this is a much bigger jump in the forward guidance indicator than we had expected, and what the underlying macroeconomic numbers would tell us it should be moving. And now the forward guidance indicator is at the highest level since 2007. So really, in terms of communication, the Fed have, based on this, turned a lot more hawkish than meets the eye, and also than has been the market reaction. So if anything, if we digest this in the coming days and think about it, it might be a signal that the Fed is even more hawkish than the dot plots are telling us, than other elements of the communications, Jerome Powell's comments. If you just look at our forward guidance indicator, it is actually quite hawkish. The most hawkish the FOMC has been since 2007. And that in itself is a signal that you still want to avoid risky assets, that the risk is for continued strengthening of the dollar. And of course, with all that, also the kind of turmoil we have seen in emerging markets is likely to continue, maybe spill over to the Eurozone. Of course, we will soon have a ECB rate decision that in itself could bring some jitters. But again, just let me repeat, our forward guidance indicator jumped very significantly on this statement, much more hawkish than we had expected, much more hawkish than market pricing in our view. It's still not reflected in market pricing that we got the change of communication as I see it. So there might be a risk that we going forward will price in even more aggressive Fed than we're getting right now. So that's the conclusion. On the surface, more or less as expected, but our forward guidance indicator might reveal that underlyingly we have a much more hawkish Fed than we expected previously. Thank you very much.